Okay, so let's start. So I want to introduce this topic of group cash flow statements. In your introduction of accounting, you learned how to prepare, a cash flow for a normal individual company, So before we look at how to prepare a group statement of cash flow, let us also remind ourselves how you used to prepare a cash flow statement for an individual company, You remember you had to classify the cash flows into three categories. You remember you had to classify the cash flows into three categories. The first category of the cash flows was you had to determine what you used to call cash flow from. Operating activities. You used to determine what we call cash flows from operating activities. So you had to determine all the cash flows that are from the operating activities of your company. Whatever they were, you had to list all of them. I hope you remember that. Once you listed all of them, you had to get the totals. And whatever the total you are getting, that total you had to push it to the next column. That total, listen, if it was a positive amount, you used to call it net cash inflow. From operating activities. Net cash inflow from operating activities. So you had to identify what are the cash flows from your company that are from the operating activities. Once you identify them, you used to get the totals. That's what I'm saying. You used to get the totals, and that total you had to push it to the extreme. And that total, if it was a positive, you used to call it net cash inflow from operating activities. Of course, if it was a negative, you used to call it cash flows from if it's a negative, you used to call it net cash outflow, from operating activities, Once you are through with the cash flows from operating activities, you remember you had to go to the second category. Categories of the cash flows, and that is cash flow from investing activities. I hope you remember you used to identify your cash flows from investing activities. You had to identify the cash flows from investing activities again. Some of them were positive, some of them were negatives. Whatever it is, some of them were positive, some of them were negative. Once you identify all your cash flows from the investing activities, again, you used to get the totals. You used to get the total of all of them. Again, whatever is the total, you used to push it to the extreme. Let me assume now that maybe your negatives now are more than the positives. If the negatives were more than the positive, then that amount, which is the overall, automatically will end up being a negative. If it's a negative, you used to call it net cash outflow. You used to call it net cash outflow from investing activities. Net cash outflow from investing activities. That's what you used to do. That is what we are saying as the second categories of the cash flows. Once you are through with the operating activities and now you are through with the investing activities, then you had to now go to the last class of cash flows, and that was what you used to call cash flows from where? Cash flows from where? From which category now? Obvious, from what we were calling financing activities. You had to get what we call cash flows from financing activities. Cash flows from financing activities. Again, you had to identify all the cash flows from your financing activities. Once you identified all of them, you had to get the totals. Of course, some will be positive, some will be negative. Again, you had to get the totals of the net of all those cash flows from financing activities. Whatever net you got, you had to push it again to the extreme. Assuming it's a positive, you used to get that positive. If it's a positive, you used to call it net cash inflow. You used to call it net cash inflow from financing activities. You used to call it net cash inflow from financing activities. That's what you used to do. Then once you are through with the three categories, that is the cash flow from operating, you add the cash flow from investing, you get the total, you get the cash flow from financing, you had to add those three totals, you had to add the three totals, whatever it is. Whatever you get now, it could be a positive, it could be a negative. In other words, you had to add the cash flow from operating activity, the net amount, which was in our case net cash inflow from operating. That amount, you take it and add to our figure we got from the operating, whatever it is. Ours was a negative, so it was cash flow, net cash outflow from operating. It was net cash outflow from investing activities. Once you got that amount, then you had to add the third category of the cash flows, which is cash flows from in financing activities. Once you add those three, whatever total you got, that could either be a positive or a negative. If you got the answer of the three figures, if you got the answers of the three figures as a positive, you used to call it increase. You used to call it increase in cash and cash equivalent. I hope you remember. You used to call it increase in cash and cash equivalent. That's what you used to call it. Then you automatically, you remember, you had to add what we call you had to add what we call opening. You had to add what we call opening cash and cash equivalent. You had to add the opening cash and cash equivalent, whatever it is by the beginning. Don't forget, whatever was the closing cash and cash equivalent last year, that automatically becomes the opening cash and cash equivalent by beginning of this year. Whatever was the closing cash and cash equivalent last year, that automatically became the opening cash and cash equivalent. Then once you got there, that you add it to the increase amount or whatever it is you get. That amount you get there should be the same as what we are calling the closing cash and cash equivalent. What you are calling the closing cash and cash equivalent. That should be the same as you are closing by end of this year according to your statement of financial position. In other words, according to your balance sheet, what is the closing cash and cash equivalent? Whatever is the closing cash and cash equivalent by the end of this year, it should be the same as what you are getting here. It should be the same as what you are getting here. So that's how you used to determine or to prepare. That's how you used to prepare a cash flow statement in general. I've given you a general overview of how you used to prepare a cash flow statement. You had to take the cash flows from operating activities, get the cash flows from investing, get the cash flows from financing, add the three figures, get the increase or it could be the decrease in cash and cash equivalent. If it's a negative, you call it decrease in cash and cash equivalent. If it's a positive, you used to call it increase in cash and cash equivalent. Okay. Then once you get the totals of the three, you had to add what we call opening cash and cash equivalent. Then you had to get the closing cash and cash equivalent. Now, having said that, now let's now go and determine or remind ourselves how you used to determine the cash flows from each of the three categories. The cash flows from each of those three categories. How are you determining the cash flows from each of those three categories? To determine the cash flows from each of those three categories now. So how are you determining now? To get the cash flows from operating activities, I do hope you remember, to get the cash flows from operating activities, let me now take it from there. To get the cash flows from operating activities, what were you doing? You had to determine, okay, you had to start with what you used to call the net profit before what? The net profit before tax. I hope you remember. To determine the cash flows from operating activities, you had to start with the net profit before tax. You had to start with the net profit of the company before tax. That's what I'm hoping you remember. Then you had to adjust that profit before tax, you remember, with all the non-cash items. I hope you still remember. You had to adjust that non-cash item with all there with all the non-cash items that are in the income statement, you had to adjust the profit before tax, you remember, with all the non-cash items. And some of the non-cash items, like which ones? Which are some of the examples of the non-cash items that you used to adjust? When you are in the previous accounting, when you were doing this topic before, what are some of the non-cash items that you used to adjust this figure with? One of them, obvious, is the depreciation charge for the year. Whatever was the depreciation charge for the year, that depreciation charge, you remember, had to be added. Whatever is the depreciation charge for the year, that one, you remember, had to be added. And remember, we are trying to determine cash flows from operating activities. We are trying to determine cash flows from operating activities. And I hope you still remember what are the operating activities. We are trying to get all the cash flows that are from the operating activities. And operating activities, you know, are those activities that are used, those transactions and events that are used in the determination of profit. Those events and transactions that are used in the determination of the profit, those are the ones we normally call the operating activities. Those are the ones we call the operating activities. So if we want to determine the cash flows from operating activities, then we are saying all the transactions that were used in the determination of profit, those transactions are the ones that we are calling operating activities. But don't forget now, we are determining the cash flows from operating activities. So if you took to the income statement some transactions that you used to determine the profit in your company, but those transactions are non-cash transactions, then we are now saying use them to adjust this profit before tax. And I'm saying you take the profit before tax, you had to adjust it with all the non-cash items. That most obvious one, the most obvious non-cash items were things like depreciation. That is obvious, it was a non-cash item. Another one which always you will find in a question, the other one we always find in a question is what we call the finance cost, Whatever is the finance cost charge. Listen, whatever you as a company you charge in the income statement, that is not something you may have paid. It is the charge for the year. Whatever is the finance cost in the income statement, that is the charge for the year, not what you actually paid. So whatever is the non-cash item, we are trying to identify some of the non-cash items that went to the income statement. One, it could be the depreciation charge for the year. That's a non-cash item. I have said another common non-cash item is the finance cost, what you charge in the income statement as finance cost, okay? Another one could be maybe there was a disposal of an asset, and that disposal gave us a loss on disposal. That loss on disposal of an asset, were you adding or subtracting? Whatever was the loss, it is obvious you must have been adding. Why were you adding? Of course, don't forget, we are saying that loss on disposal, you debited it in the P&L account, yet it did not affect any cash flows. So when you debited P&L account, and it is a non-cash item, what effect did it have on your profit? We are saying it made your profit less because it's a non-cash expense, and you debited it in the P&L account, it made your expenses overcasted. When expenses are overcasted, profit is undercasted. Don't forget, we are trying to determine the profit purely on cash basis. That's why we are calling it operating activities. Then you look for any other. If there was things like impairment of goodwill impairment, again, that is another non-cash item that went to the P&L account. Goodwill impairment is another item that could have gone to the income statement. Any goodwill impairment, whatever it is. Of course, you debited P&L account with any impairment loss of the goodwill. that impairment loss is not something you paid during the year. It's not something you paid during the year. So that's another example of an uncashed item that could have gone to the income statement, that could have gone to the income statement. What is another example of an uncashed item? This could be, maybe now again, you sold another asset and you made a profit on disposal. If there was a profit on disposal, of an asset, again, you took it to the income statement as a gain. You took it to the income statement as a gain, yet you never received anything. You never received anything of that amount that you are calling the profit on disposal. I am not talking of the cash you received on disposal. No, I am talking of the gain or the loss on disposal. Those two are non-cash items. It is something you took to the P&L account and yet you never received or paid for that entry, for that amount, which is a gain or loss on disposal, on disposal. So we are giving another example of an uncashed item is the profit on disposal. You took it and took it to the P&L account. That means you recognize a gain in the P&L account, yet that gain is not involving any cash. So with that gain, what effect did it have on your profit before tax? It made your profit before tax more than it should be. So in that case, you now come and minus if there was a profit on disposal. Another example of an uncashed item that you could have been using in your computation of the cash flows from operating activities were which one? Give me another example of a non-cash item that could have gone to the income statement and yet there was no adjustment for it. There was no cash flow for it. The other one could be maybe amortization of intangible assets, whatever it is. Again, you debited the P&L account with that amortization, yet you never paid for that amortization amount. It is just another non-cash item. So that's what we are saying. Another example of a non-cash expense that could have gone to the P&L account again, any other that could have gone to the P&L account again, is things like provision for bad debts. When you as a company you anticipated that some of your debtors are likely not to pay you, you made a provision for bad debts. So if there was an increase in provision for bad debts, that increase in provision for bad debts automatically was recognized in the profit and loss as an expense. Okay? And therefore, we are saying, by you recognizing an increase in provision for bad debts, and yet you never paid anything for that, that's another non-cash item. Of course. Okay? Of course, if it was a decrease in provision for bad debts, you must have recognized it as a gain in your income statement. And therefore, when you recognized it as a gain, it made your profit more than it should be from the cash point of view. And therefore we are saying you would have deducted. But for now, I want to assume that there was an increase in provision. From last year to this year, there was an increase in provision. And if you took an increase in provision, then you recognize a loss in the income statement. That loss or that debit you recognized in the P&L account did not affect cash flow. It is just a bookkeeping entry. So for now, let me assume it's an increase in provision, whatever you get. Okay? Once you are through with that, listen now, once you're through with that, you had to, I hope you still remember, you had to get the totals of all those items. You had to get the totals of all those items, and then whatever you got as the total, what were you calling it? Obvious, you used to call it cash flow. Before what? Cash flow before working capital changes. Cash flow before working capital what? Changes. That's what you used to call it. Cash flow before working capital changes. Then you now go and implement the working capital changes. I hope you still remember them. What are some of the working capital changes? What are they? For example, you could have been told there was an increase in stocks. There was an increase in stocks. Were you considering that as an inflow or outflow? In other words, were you taking that amount as a positive or negative? If there was an increase in stocks, is it an inflow or an outflow? What were you saying in your previous introduction of accounting when you are learning this topic? Remember, we are reminding ourselves what we used to do. So this is obvious. When there's an increase in stocks, that used to be considered as an outflow. Why? Because for stocks to go up, you as a company, you must have purchased some more stocks. Again, you go back and find out what about the change in any other working capital. Working capital includes things like current assets and current liabilities. So you had to come now and analyze. Maybe from stocks, you normally go to debtors. So you came and now saw that this time there was a decrease in debtors. Decrease in debtors. What happens if there's a decrease in debtors? Is that an inflow or outflow? We are saying if your company has a decrease in debtors from last year to this year, it's automatic. It is automatic that as a company, you must have received from your debtors. You must have received from your debtors, okay? That is an inflow. So let me assume that those are the only working capital items under current assets. Of course, I am saying you know that though cash or bank, though cash and bank are part of the working capital as current assets, we normally don't analyze the change in the cash and bank. I hope you know that. I hope you still remember that. We normally don't analyze the amount of cash and bank under the working capital changes. No. Why? Because we have it placed down there. You remember, we said once you add the three categories, we said you are supposed to get the totals of the three. Then that total, call it increase in cash and cash equivalent. Then I told you to add the opening cash and cash equivalent. I told you to add the opening cash and cash equivalent. Once you add that, which is what was the closing last year, that is what we are saying. That's the place where the cash will come in. It comes in as part of cash and cash equivalent down there in the cash flow statement. So we don't analyze the cash flow among the working capital items. No. Okay. Then from there, another category of the working capital are the current liabilities. Now are the current liabilities, which of course may include things like creditors or what you can call trade payables. So suppose you analyze the trade payables or the creditors and you realize that this time there was a decrease. There was a decrease in creditors, a decrease in creditors. For creditors to go down, what must have happened? For creditors to go down, automatically you must have paid them. For creditors to go down from last year to this year, you as a company, you must have paid them. You must have paid them, okay? So for now, let me assume that those are the only working capital items. Those are the only working capital items in your statement of financial position. Then you had to get the totals. You had to get the totals. I'm only reminding you what you used to do. So we had to get the totals, and whatever the total you got, you had to come and now say what? Less tax paid. I hope you still remember. You had to minus whatever is the tax paid. Once you minus the tax paid, the amount you got now, listen, the amount you got, that is what you are pushing to the extreme. That's what you are pushing to the extreme. And that gives you now the total amount of the cash flows from the operating activities. And I'm now saying if that amount is a positive amount, then you had to call it, if it's a positive amount, then you had to call it net. You had to call it net cash inflow. You had to call it net cash inflow from operating activities. You had to call it net cash inflow from operating activities if it was a positive. Okay, so tumesema when you are determining cash flows from operating activities, what do? You start with the profit before tax. Then I have said adjust it with all the non-cash items. Adjust it with all the non-cash items. If that non-cash item made your profit more than it should be, then I'm saying you deduct. You have to deduct so that you get the true profit in cash terms. If the non-cash item was an item that reduced your profit, then you add. If it made your profit more than it should be, then you deduct. Some of them we are saying, like all expenses that you debited in the P&L account and yet they are non-cash items, all of them must have reduced your profit. Things like depreciation, loss on disposal, impairment, amortization, provision for bad debts. All these are non-cash items that you debited in the P&L account. By debiting them in the P&L account, they made your profit less than it should be from the cash point of view. Mark you, from the cash point of view. That then we are saying, once you know that they made your profit less than it should be, you add back. Then we are saying, in the same income statement, are there things you took to the income statement which made your profit more than it should be, and therefore, because they were not cash items, I use them now to reduce our profit. I have given an example like the profit on disposal. You sold an asset, made a profit on disposal, you recognize that profit on disposal in the income statement, yet you never received that amount. I have said it's not the cash you received on disposal that we are talking about. I have said it's the gain on disposal. It's the gain that you made on disposal. That gain, you recognized it in the P&L account, and yet yet you never received that amount. It's just a bookkeeping entry. Once you get the profit before tax and you have adjusted with all non-cash items, I've said get the total, and that total is what I've said becomes the cash flow before working capital changes, is what we call the cash flow before working capital changes. Then I've said analyze the working capital items. We have said things like increase in stocks, that's an outflow, decrease in debtors, that's an inflow, decrease in creditors, that's an outflow. Assuming those are the only working capital items, get the total of that, get the total of all that. Then you come and minus what we are calling the tax paid. You minus tax paid. Once you minus tax paid, I've said whatever answer you get, you push it to the extreme, and that becomes the net cash inflow from operating activities. Becomes the net cash inflow from operating activities. Then you now go to the second categories of the cash flows. You go now to the second categories of your cash flows, and those are the cash flow categories we want to call cash flow from investing. Cash flows from investing activities. What we call cash flow from investing activities. What you call cash flow from investing activities. Cash flows from investing activities. That's the category we want to go to next as number 2. What are the cash flows from investing activities? Okay. Of course, you know what investing activities were. You remember what investing activities were. These are transactions that affect any fixed asset. Any transactions that affect fixed asset, that category of transaction or event that affects a fixed asset, that is the category or transaction we should classify as investing activities. So give me one or two examples. Give me one or two examples of transactions that you had to classify as investing activities. In other words, give me examples of investing activities. What are some of the examples of the investing activities in your company? What are some of the examples of investing activities? One could be purchase. One of them could be purchase of fixed assets. Purchase of fixed assets. Maybe you bought a machine, or you bought a motor vehicle, or you bought a furniture, whichever it is. When you buy a fixed asset, that transaction is classified as an investing activity, and therefore that is obviously an outflow. That is obviously an outflow. Okay? So we have said investing activities are those transactions that affect fixed asset. That means all the transactions that affected fixed assets in your company, those transactions should be classified as investing activities. So I've given an example, purchase of a fixed asset, maybe motor vehicle, furniture, whatever, that you bought as a company during the year. Okay. Another one could have been sale of fixed assets again. Sale of fixed assets. whatever it is, when you sold some of the fixed asset, that cash you received from the sale of fixed asset, that is the amount we classify as an investing activity. That's the amount you classify as an investing activities, okay? Another one could be, maybe as a company, among your fixed assets, you have investments, which are long-term investments, mark you. Don't forget, I have said, investing activities are those transactions that affect fixed assets, So among your fixed assets in your balance sheet, there could be some investments which are long-term. And maybe last year, the investments were 2 million. This year, the investments were maybe 3 million. In other words, you could have purchased some more investment. So we come and say your purchase of investments. Purchase of investments. Purchase of investments. Whatever it is, that's an outflow, okay? That's an outflow. Listen again. I have said, investing activities are those transactions and events that affect any fixed asset. Any transaction that affects a fixed asset is classified as investing. Listen now. From the same investments that you have, from those investments that you have, you as a company, you have received from them some investment income, maybe in form of dividends or whatever form. But from your investments, you could have received some income. That income you received from an investment is also classified as investing. Don't forget, investments, we are looking at them as those which are long-term. Those same investments, if they give you an income, that income is related to a fixed asset. And we have said investing activities are those transactions that affect any fixed asset. So we are now saying, in such a case, we come and now say investment income, investment income. We come and now say your investment income, whatever it is, that is what you received from your where? From your investments. And investments are investing activities, okay? So if you received an investment income from an investment, then that should be classified as an investing activities. For now, let me assume those are the only ones that are given to you as per the question. Then you get the totals again, push it to the extreme. Get the totals, push it to the extreme. Let me assume now that your negatives are more than the positive. Let us assume that your negatives are more than the positive. And if your negatives are more than the positive, then automatically you have to come and call this one now net cash what? Net cash outflow. Because it is a negative, you call it net cash outflow from investing activities, If it's a negative, you call it net cash outflow from investing activities. Then you go to the third category now. You now go to the third category, which we called what? Third category, we called it what? We called it cash flow from where? We said it's cash flow from financing activities. You call it cash flow from financing what? Activities. You call it cash flow from financing activities. Again, identify them. Some may be positive, some may be negative. Remember, from your previous accounting, you learned what are financing activities, and we are saying these are transactions and events. These are transactions and events that affects any form of finances, any finances changes, any transaction affecting finances, that is a transaction that should be classified as financing activities. And give me examples of them. Give me some examples of financing activities now. Give me some of the examples of financing activities. What are they? Examples of financing activities. Obvious, one of them could be issue of shares. I hope you still remember issue of shares, whatever it is, from your company, you issued shares. That means you are raising finances. You are raising finances. So that is obviously an inflow. That is obviously an inflow. Maybe during the year again, your company issued some debentures. You still borrowed by issue of debentures. So if there was any issue of debentures, then automatically you raise some money by issuing the debentures. That's an inflow again. Maybe during the year, the amount of the loan that you have has gone down. For the loan, which is part of financing, maybe the loan has gone down. So if the loan has gone down from last year to this year, then automatically that loan repayment will automatically be part of the financing, but it is an outflow. Listen now, but it is an outflow. Once you do that, then I have identified the major financing activity items. But then, whatever you normally pay, whatever you normally pay to the financiers as their return, whatever you normally pay the financiers as their return, whatever you normally pay them, that which you pay them as their return on investment is what we classify also as financing. I have said financing activities are those transactions and events that affect finances, So for example, from the shareholders who have been able to finance us, what is it that we normally pay them? We normally pay them dividends. So because you are paying dividends to the financiers, we normally classify dividends paid as part of financing. So you come and say here, dividends paid. That's what you are doing. You remember, you had to minus the dividends paid. Then, to the debenture holders or to the loan providers, you normally pay them what? To the loan providers or to the debenture holders, you normally pay them a return called what? You normally pay them a return called what? You normally pay them a return called interest. So whatever is the interest paid during the year, whatever you paid them during the year, that is what you consider as a part of financing. Listen, so this is interest paid. When I was looking at operating activities, I said one of the non-cash items I told you, one of the non-cash items I told you is the finance cost. That finance cost is of course the interest, but what you took to the cash flow among the non-cash item, it is the charge for the year, not what you actually paid, the charge for the year. That was a non-cash item. But what you actually paid for interest, is what you now classify as a financing activities. What you now classify as a financing what? Activity. So that's what we are saying. So whatever is the interest paid, that is financing. For now, let me assume those are the only ones. For now, let me assume those are the only financing activity item. I'm assuming those are the only financing activity item. Then you get the total again. You get the total and you push it to the extreme. You get the totals and push it to the extreme. Once you get the total, let me assume again that that total you are getting is a positive amount. If it's a positive, you used to call it net cash. You used to call it net cash inflow again. You used to call it net cash inflow. You used to call it net cash inflow from where? From financing activities. You used to call it net cash inflow from financing what? Activities. You used to call it net cash inflow from financing activities. Then once you are through with the three categories, I told you, you now add the totals of those three figures. The operating one, the financing, and the investing. You add the total of those three. Then I told you, if you get the answer there of the three totals, once you get the answer there, I said, if it's a positive, you call it increase. If it's a positive, I said you call it increase in cash and cash equivalent. If it's a positive, you call it increase in cash and cash what? Equivalent. If it's a negative, obviously, you will call it decrease in cash and cash equivalent. Okay? Then I told you, you normally come and add now, you normally come and add what we call opening. You normally come and add what we call opening cash and cash equivalent. This is opening cash and cash equivalent. Opening cash and cash equivalent. whatever it is you earned. Then you get the total, whatever it is, and that total you get is the same. It should be the same as the closing. It should be the same as the closing cash and cash equivalent. It should be the same as the closing cash and cash what? Equivalent. So I've given you the general format. I've now given you the general format of how you used to prepare, listen, how you used to prepare a cash flow for an individual company. For an individual company, you had to take or get the cash flow from operating activities, I've said, get the cash flow from investing, get the cash flows from financing, get the totals of those three, add the opening cash and cash equivalent, get the closing cash and cash equivalent. Then I've said, how are you getting the operating cash flows? To get the operating cash flows, we were starting with the profit before tax. Okay? You start with what I said is the profit before what? You start with the profit before tax, whatever it is that the question will give you. Start with the profit before tax. Once you start with that profit, then go find out from the question, what are some of the non-cash items, what are some of the non-cash items that you took to the income statement, yet they are not involving any cash, either as an inflow or as an outflow. So use them to adjust the true profit. Use them to adjust the profit. So if it's an item that went to the P&L account as a debit, it means you debited P&L account with that item, yet you never paid for that item in cash. That effect, again, we are saying, what effect did it have? What effect did it have on your profit? If you debited P&L account with that item, then it made your profit less. To correct, we have said you do what? You earned. We have said to correct, you earned. We have given examples like the most common one is depreciation. That one you will never miss in any question. You should never miss in any question. The other common one again is the finance cost. Those two normally are common in almost every question. Finance cost and the depreciation. So those two, you pick whatever you are calculating or whatever they have charged in the income statement as interest, whatever they have charged. Either they call it interest charge or they call it finance cost. It is what went to the income statement as a charge, okay? So that amount of finance cost is another non-cash item. Then we have identified others like loss on disposal, impairment of goodwill, whatever. Profit on disposal, we have said, any profit on disposal, of course, you recognized again in the P&L account, but you never received it. It made your profit more than it should be. Then I've talked about amortization. Again of the intangible assets, of course. That's another non-cash item. Then I've talked about provision for bad debts, whether it's an increase or a decrease. If it's an increase, it's a loss. If it was a decrease, it was a gain. Then once you do that, get the totals. We have said, get the totals of the three categories, and the total of those three categories is what we call cash flow before working capital what? Cash flow before working capital changes. Once you get the cash flow before working capital changes, we have said now incorporate the working capital items. Once you incorporate the working capital items and the changes, whether as an inflow or outflow, whatever, get the totals. I've said you now minus the tax paid. Whatever you get after minusing tax paid, that figure we said you push it to the extreme, and that is the figure we call net cash inflow from operating activities. If it's a negative, it will be net cash outflow from operating activities. Then I said go to the second categories of the cash flows now, which we call cash flows from investing activities. Okay? And I've given examples of investing activities like purchase of fixed assets, you remember, sale of fixed assets, that's an inflow, purchase of investments, that's an outflow. Then I've said, because investments are part of long-term assets, which are fixed assets, any income you receive from your investment, that should also be classified as an investing activity. Okay? Let us assume that those are the only ones. You get the totals. Whatever you get, push it to the extreme. I have said, if it's a positive, you call it net cash inflow from investing. If it's a negative, you call it net cash outflow from investing. Ours, we assumed it was a negative, and therefore we called it net cash outflow from investing activities. Then you go to the third category, and that is category called cash flows from financing activities. All those transactions that affect finances, all those transactions that affect finances in your business are the ones we classify as financing. Could be issue of shares, could be issue of debentures, could be loan repayment, and so on. Once you identify the major finances, then I've said, whatever returns you pay to your financiers, those returns that you pay to them are classified also as part of financing. To the shareholders, you must have paid them dividend. That's an outflow. That's an outflow under financing. To the debenture holders, you must have paid them interest. That's also financing. Whatever you get the totals of all your financing activities, push it to the extreme, call it net cash inflow or net cash outflow from financing. Then you add the three totals of the operating, the financing, and the investing. Add those three figures. The answer you get, I have said, becomes either an increase or a decrease in cash and cash equivalent. Then you add the opening cash and cash what? Equivalent. Okay. So I think I've reminded you how you used to prepare a cash flow for an individual company. I've reminded you how you used to prepare a cash flow for an individual company. Okay, now we want to go and look at some of the aspects that affect group. You have a group now, and you want to prepare the cash flows for that group. You want to prepare the cash flow statement for that group. This group, which you are the holding company, you are now required to prepare a group cash flow statement. So the only thing we want to introduce, which was not part of what you did earlier in your cash flow, the only thing we want to introduce, which is not part of what you did earlier in the cash flow, is one. How do you account for an associate? How do you account for an associate when it comes to group cash flow? That's one thing we want to talk about now, as far as group is concerned. Another thing we want to talk about, we want to remind ourselves how do you account for what we call non-controlling interest? How do you account for what we call non-controlling interest as far as cash flow is concerned? How do you account for the non-controlling interest? Listen. So these are the only two items I want to talk about. These are the two items I want to talk about which affect group cash flow. Once I get them, now we shall now continue and determine. We shall now continue and now do the workings of the cash flow. Now, before I continue, let me say this. You know, in your previous accounting, you know that anytime the examiner used to give you a question on cash flow, he normally gives you an income statement and a set of two financial statements, two statements of financial position, one for last year and another one for the current year. You know that you were given two statements of the balance sheet. One balance sheet for last year, another balance sheet for this year. Okay? And then I have said in a normal question, you are normally given an income statement for the current year. You are given an income statement for the current year. You are given an income statement for the current year. Okay? Now, if it's a group question that you are doing, then you will be given, a group P&L account for the current year, and you'll also be given one balance sheet for the group last year and another balance sheet for the group this year. So before we look at how to account for an associate in the cash flow, you need to know how an associate is accounted for in the group P&L account. because you cannot account for it in the cash flow unless you first know how it is accounted for in the balance sheet and also in the P&L account. This is just to remind you again, we have done the topic called group accounts. We have done the topic called group accounts, and therefore you should be able to know how to account for associate and also how to account for the non-controlling interest. We have done the topic of group, and therefore you should know how to account for this too. But just to remind you, you remember, we said that when you have an associate, listen, when you have an associate and you are consolidating it in the group P&L account, we said you normally determine an amount we call profit, listen, profit after tax share from the associate. Profit after tax share from the associate. That is one of the things that normally go to the group P&L account when you are consolidating an associate. So from the associate's P&L account, remember, you are the holding company. Now you are required to prepare group P&L account. You have the holding, you have a subsidiary, and you have an associate. When you have an associate, you normally don't consolidate that associate in the income statement the same way you consolidate an associate. No. For associate, we said there are normally two things. I hope you remember. We said there are normally two things that normally you pick from them to the group P&L account from an associate. One is your share of their profit after tax. One is your share of their profit after tax. That's one. The second thing that you normally bring in from the associate to the group P&L account, of course you remember, is your share of their post. I hope you still remember your share of their post acquisition retained profit brought down. Your share of their post acquisition retained profit brought down. So that's how you normally account for an associate in the group P&L. One, you bring your share of their profit after tax. That's what we said. Number two, you normally bring your share of their post acquisition retained profit brought down. Good. What about in the balance sheet? How are we accounting for? How do you account for an associate in the balance sheet? You remember we said when you have an associate and you want to consolidate it in the balance sheet, you don't consolidate it again like you consolidate your subsidiary. No. For subsidiary, you normally take all their assets, you combine them with yours, take all their liabilities and you combine them with yours. But when it comes to associate, I hope you still remember, we said to account for an associate, you normally just determine a single amount. What is that single amount? You normally determine one single amount. That single amount, what do you call it? We normally call it investment in what? In associate. I hope you still remember how to consolidate an associate in the balance sheet. You normally determine a single amount where we said you call it investment in associate. We call it investment in associate. Whatever you get as your investment in associate amount, you remember that amount we were saying, you take it to the group balance sheet as an asset of the group, as an asset of the group. Are you there now? Good. Among where? Among the fixed asset. You normally take it as an asset of the group among the fixed assets, Good. Let's continue now. Okay? So, just to remind you, for an associate, I have said, because the examiner will give you a group P&L account, in that group P&L account, somewhere among that group P&L account, somewhere in the group P&L account, for this associate, you will have what we are calling profit after tax share from associate. Profit after tax share from associate, whatever it is. Normally you add it. You normally add it as an income to you. It's normally added. Then I've said, the examiner, when he gives you a question on cash flow, he will give you a cash flow, a balance sheet. This is balance sheet. He will give you a balance sheet. We have said one for last year. Let us assume last year was 2019. And another one for 2020. I am assuming this year. Then I've said among the fixed assets, we said, how do you account for an associate? We said you normally determine a single amount. You normally determine a single amount by the name of investment in associate. Once you get it, I don't want to remind you how, because we are doing cash flow, but we know that you normally determine a single amount called investment in associate. Investment in associate. Then I told you, among your fixed assets in the balance sheet, you as a group, you normally take it now, this is group balance sheet, you normally take it to the group balance sheet as an asset under fixed asset by the name of investment in associate. Investment in associate. Don't forget, I have said, in as far as cash flows are concerned, the examiner will give you one balance sheet for the previous year and another balance sheet for the current year, whatever it is. One balance sheet for the previous year and another one for the current year. So in the balance sheet for last year, you will see an amount called investment in associate, and in this year, you will see another amount called investment in associate. Listen now. So I have reminded you, how to account for an associate, both in the P&L account and also in the balance sheet. But don't forget, we are not preparing group P&L account, we are not preparing group balance sheet, we are preparing group cash flow. Okay? So how then, now listen now, how then does associates affect cash flows? That's what I want to talk about now. How then does do associates affect group cash flow? Now listen. So we want to ask ourselves, the relationship between this group of ours, the relationship between the group. When I say group, I am referring to the holding and its subsidiary. An associate is normally not considered as a member of the group. An associate is normally not considered as a member of the group. So when we say group, we are referring to the holding and its subsidiary. If one of us has an associate, let me assume it's the holding company. We have an associate, which we are controlling maybe 40%. So we are asking ourselves this question. The relationship between this group of ours, the relationship between the group and its associate. Listen, the relationship between the group and its associate, when it comes to cash flows, what is it that is involved? When it comes to cash flows? Not to profit share, not amount called investment in associate, no. When it was balance sheet consolidation, we were consolidating, you determined an amount called investment in associate. When you are required to do group balance sheet. When you are required to determine or to prepare group P&L account, you had to determine your share called profit after tax share. Your profit after tax share. And you took it to the P&L account of the group as an income. But now we are discussing how associates affect cash flow. Yet I have said the examiner will give you an income statement for the group for the current year and two balance sheets, one for the previous year and one for the current year, group balance sheets. So the question is this: the relationship between this group of ours and our associate, when it comes to cash flows, what is it that is involved? Is it the profit share? No. Is it the amount called investment in associate? No. What is it that is involved? Listen, what is it that is involved when it comes to cash flows? That's what I want to talk about now. Listen now. So our relationship, with our associate, when it comes to cash flows, listen, when it comes to cash flows, you as a holding company, you have to calculate what we call the cash dividend. The cash dividend received from your associate. The cash dividends received from your associate. Remember, you control 40% shares in that associate. Whatever the associate, listen now, whatever the associate paid to their shareholders as dividend, whatever the associate paid to their shareholders as dividend, you as a holding company, you must have been paid part of that dividend. Why? Because you are a shareholder in this associate. You are a shareholder in this associate. So we are concluding by saying whatever the associate paid to their shareholders as dividend, you as a holding company, you must have been paid part of that dividend. Okay? So it is that dividend, listen, that me as a holding company I received. Listen now, it is that dividend that me as a holding company I received from my associate. That is what affects the cash flows. When it comes to associate, that is what affects the cash flows. So when you are doing a group cash flow question and there is an associate, we are saying you must calculate. Listen now, you must calculate what we are calling the cash dividend received from the associate. You must determine the cash dividend that you as a group you received from the associate. Feel it? Listen. To determine that cash dividend, once you calculate it, listen, once you calculate the cash dividend received from the associate, now you take it to your cash flow statement. Now you take it to your cash flow statement among your investing activities. Among your investing activities now, remember, we said investing activities are which kind of activities? Are those activities that affect anyone. We said investing activities are which kind of activities? They are those activities that affect any fixed asset. I hope you remember any fixed asset. Good. Now that an amount called investment in associate is in our balance sheet as a fixed asset, anything relating to it, which we are saying is cash dividend, that cash dividend that you are receiving from your associate becomes an investing activities. So once you calculate it, listen, once you calculate the cash dividend received from the associate, that cash dividend received from the associate should be considered as an investing activity item in the cash flow statement. So among your investing, there you will have what we are calling cash dividend received from associate. Cash dividend received from the associate, that of course will be an inflow. That will be an inflow. That means that's what you are saying, that your cash dividend you are receiving from the associate becomes an inflow. Okay? Now what remains is this. How do you calculate it? Listen, we have only said that the relationship between the group and its associate, when it comes to cash flows, you determine the cash dividend that we as a group we received from our associate, Then I have said, once you get that cash dividend received from the associate, I have said, take it to the group cash flow statement as an investing activity. But now the question comes, how do you determine that cash dividend received from your associate? How do you determine that cash dividend? For purpose of illustration, let me assume that in your income statement, you are given what we have called profit after tax share from the associate. Let us assume you are given an amount. In that income statement, I want to assume you have been given an amount of maybe 300,000 as your profit after tax share from the associate. Remember I said you added. Then you also prepared as a group. You also prepared balance sheet of the group. So for purpose again of illustration, let me assume that the question from the balance sheet of last year, your investment in associate amount was maybe an amount of 500. Okay. Then maybe by end of this year, the examiner gives you, in that question on cash flow, the examiner gives you an amount called investment in associate by end of this year amounting to 700. So in the income statement, you have a share of profit of 300. Last year, your entitlement in associate was 500. End of this year, your investment in associate has an amount of 700. That means your entitlement. So what is the amount of the dividend we received from our associate? Now we are saying, to determine the cash dividend received from the associate, to determine that cash dividend received from the associate, we shall be opening an account called investment in associate. We shall be opening an account called investment in associate. You go to the balance sheet last year, bring down your entitlement last year. From the balance sheet of last year, what was our entitlement? You come and see your balance brought down. Balance brought down. From this balance sheet illustration, I can see my investment in associate last year was 500. Then I have said, whatever was your profit share for the year 2020, remember, the examiner will give you an income statement for the year 2020. The examiner will give you an income statement for the year 2020. From that income statement, me as a holding company, I am also entitled. To my profit share from this associate amounting to 300. That automatically means, listen now, that automatically means it made that profit share that I'm entitled this year makes my entitlement in this associate to grow. My entitlement by the beginning was 500. Then this year I made another profit share. I have another profit share of 300 from my associate. That makes my entitlement to grow. That makes my entitlement to grow. Okay? By how much? By 300. So that profit share, we shall be debiting it in the investment in associate account, that 300. Remember, it has been added in the P&L account, meaning it has been credited in the P&L account. It has been credited in the P&L account. That's why we are debiting this account. This account, okay? Then, from the balance sheet this year, we can see our entitlement. From the balance sheet this year, we have an entitlement amount of 700 as the investment in associate. That balance, you carry it down. That is 700. Then whatever is the balancing figure now, I have said, whatever is the balancing figure now, that balancing figure is what I said now becomes. That balancing figure is now what becomes the cash dividend received from your associate. As a balancing figure now, that is how much? Looks like exactly 100. So that 100 is what you consider now. Listen, that 100 is what you now consider as your cash dividend received from the associate, and that's what you take. Listen, that's what you take to the to the cash flow as an investing activity. That's what you take to the cash flow as an investing activity. Okay, that amount of 100,000. That's what you take. Now, before we leave this area, we have just said that you as a company, you will be given, listen, as a question, they will give you the group P&L account. In that group P&L account, you will see an amount called profit after tax share from the associate. Listen, you will see an amount called profit after tax share from the associate. That amount, I have said, did not involve any cash flow at all. What did you do when you are determining that amount? You just said, because you are controlling 40% of the associate, you took 40% of their profit after tax. You took 40% of their profit after tax and you considered it as your income. That's okay. That is okay. That's okay. But remember, did you receive 300,000? The answer is no. Listen. So that obviously, that 300,000, listen now, that 300,000 is another non-cash item. It's another non-cash item that will obviously not have involved any cash. When it comes to group, this profit after tax share is what we are calling another non-cash item. Listen. So if in the income statement you are given there, and then you are given your profit before tax here, and your profit before tax was 10 million. Listen, was that 10 million? That was your profit before tax. When you were doing this cash flow question, you went to the income statement and you picked the profit before tax. How much? You picked the profit before tax. You picked it, that amount, which in our case now we are assuming, was 10 million. Then I told you, you adjust it. I told you, you adjust it with all the non-cash items. Adjust it with all the non-cash items. Now listen, within that 10 million now, other than depreciation, other than finance costs, other than loss on disposal, other than impairment and the gain or loss on disposal, amortization and provision, listen, among it, that 10 million, there is also now another non-cash item called profit after tax share. Profit after tax share. So we are saying that profit after tax share is also another non-cash item when it comes to group cash flow. Why? Because you did not receive that 300. What you received is the dividend, which we have got as how much? Which we have got as 100. But you as a holding company, you accounted for 300,000 as your profit share. Listen, so whatever is our profit share from the associate, that also we shall be bringing it, listen, that also we shall be bringing it as another non-cash item when it comes to group cash flow. We shall be saying profit after tax share from associate. Profit after tax share from associate. That amount of 300,000, whatever it is. But don't forget, that 300,000, you added it in the group P&L account. You added it as your share of income. But now, because it did not involve any cash item, because it never involved any cash item, what effect did it have on my 10 million profit? It's obvious it made my profit more than it should be. So this time, we shall have to be deducting it. Why? Because it made your profit more than it should be. So it's another non-cash item. But what I've said, which is important, is when it comes to associate and cash flows, what do you determine? I have said you determine an amount called what? Cash dividend received from who? From your associate. What have I said also? Once you calculate it, where do you take it? I have said you take it to the cash flow statement as a what? As an investing activity. That amount, Nisawa, whatever is the amount, which in our case now, we have got it as 100,000 from our illustration. We have got it as 100,000. Obvious, it will be an inflow. Obviously, it will be an inflow. Nisawa, because you are receiving that dividend. Then I said, how do you get it? I said, to get the dividend received from the associate, you prepare an account called what? Investment in associate. I said, you prepare an account called investment in associate, where you feed in all the information concerning the associate, then there will be a balancing figure, and that balancing figure is what you call the cash dividend received from the associate. I think I'm now through with that. You go to the income balance sheet last year, pick your opening balance, which is last year, which is the opening this year. Then I've said, go to the income statement, see what was your profit share from the associate. That I've said makes your entitlement to grow, okay? By whatever the profit share. Then I said you carry down the balance by end of this year. And whatever is the balancing figure in this account now, that balancing figure now becomes the cash dividend received from the associate. Okay, that is all. Now you go to the next now. We are now through with how to account for associate. Now let us remind ourselves, or let's discuss now how to account for the non-controlling interest. How do we account for the non-controlling interest? How do you account for the non-controlling interest? So before we do an example now, let's now talk about non-controlling interest and cash flow, not non-controlling interest and P&L account. Listen again. Already we have done the topic called group accounts. And now you know how to account for the non-controlling interest both in the income statement and in the balance sheet. Everybody now knows how to account for a non-controlling interest, both in the income statement and in the balance sheet. For income statement, you know, when you are preparing group P&L, when you are preparing group P&L account, group P&L, do not forget, you normally consolidate everything of the holding plus everything of the subsidiary. In other words, if there are things like sales, you normally take everything of the holding plus everything of the subsidiary. Cost of sales the same. You normally take everything of the holding plus everything of the subsidiary again. All of that, whatever it is. So you normally consolidate the subsidiary. Listen, you normally consolidate the subsidiary, everything of yours plus everything of theirs. Then you go normally up to a point. We normally go up to a point called profit after what? After tax for the group. Then, listen, at that point in time, you normally come and say, but we were not controlling 100% of that subsidiary. We were not controlling 100% of the subsidiary. But the rule of consolidation says, consolidate as though you control 100. Consolidate as though you control 100. So it is at this point, once you get the profit after tax, it is at this point that you remember we said you normally come and less what we call non-controlling interest. What is their share of their profit? Listen, what is their share of their profit? After getting the profit after tax, you remember when we were consolidating P&L account to December, you normally get the share of the non-controlling. If I am controlling 80% in that subsidiary, 20% of what I brought in is not ours. It belongs to the non-controlling shareholders. It belongs to the non-controlling shareholders. So in simple, we normally take a percentage, which could be 20% of the profit after tax of who? Of the profit after tax of S Limited. Good. Then you normally deduct it. Whatever it is. Then you get whatever it is. Then you appropriate. So I've reminded you how to account for non-controlling interest in the income statement. Okay? But then, what about in the balance sheet? How are we accounting for the non-controlling shareholders in the balance sheet? Again, you remember, in the balance sheet also, you normally consolidate everything of the subsidiary with everything of the holding. Everything of the holding with everything of the subsidiary, again, as though you control 100%. But then, you are not controlling 100%, you're only controlling maybe 80%. So you remember we were saying, in that case, therefore, part of the net assets you as a holding company you brought into the group, part of the net assets that you brought into the group, you as a holding company, you are not the one who financed them. Part of the net assets were financed by outsiders called non-controlling shareholders. So you remember when we were preparing group balance sheet, under the section called equity and liabilities, in the balance sheet, among them, where we used to have things like ordinary share capital, you remember, we had something like retained profit for the group. It is at that point in time that we had to bring in what we were calling non-controlling interest. How much they financed the group, by. So we are saying you showed it, that amount called non-controlling interest, which we are not talking about how to get it in cash flow, because you will be given, a balance sheet of the group. So in that balance sheet of the group that you'll be given, one for last year and one for this year, you will automatically see among the equities, you will normally see an amount called non-controlling interest. So because we are doing cash flow, the examiner will give you one balance sheet for last year and another balance sheet for the current year, 2020, and another balance sheet for the current year, 2020. Now, listen. Suppose, obviously, one amount will appear in the balance sheet for last year, another one will appear in the balance sheet for this year as what we are calling non-controlling interest. So for non-controlling interest, we normally just show an amount of the non-controlling interest in the balance sheet as an equity. Now you know, now you know how to account for non-controlling interest both in the group P&L account and in the group balance sheet. In the P&L account, we normally say, what is their share? What is their share of the profit after tax? What is their share of the profit after tax? Maybe for the purpose of illustration, let me assume that in your income statement, the profit after tax share belonging to the non-controlling interest may be an amount of 400,000. Let me assume so. That amount, don't forget, we normally deduct it. in the P&L account. Then let me assume now, for purpose again of illustration, that by end of this year, in your balance sheet, by end of last year, the outsiders called non-controlling interest, maybe they financed by the group. They financed the group to an extent of 1 million. Then maybe by end of this year, maybe the amount they are financing the group by amounts to something like 1.3 million. Maybe you are given, I'm giving just an example, maybe you are given an amount of 1.3 million. So again, listen, me as a holding company here, I own a subsidiary. I only control 80% of their shares. We are the group. 20% of the shares in S are owned by the NCI. Those are the guys we are talking about. They are owned by the NCI. 20% of the shares in SCI are owned by 20% of the shares in subsidiary are owned by the non-controlling shareholders. So again, the relationship, now listen, the relationship between this group and its 20% shareholders down there, the relationship between the group and the 20% shareholders down there, when it comes to cash flows, what is it that is involved? What is involved as far as cash flows are concerned? It's not our profit share. Remember, in the income statement again, you have that 400,000 as your profit share from the associate, you have the profit after tax share that belongs to the NCI. But that is just their share of the profit. Doesn't involve cash. Then in the balance sheet, we are showing by how much they financed the group, by how much they partly financed the group. But now we are saying the relationship between this group and its non-controlling shareholders, when it comes to cash flows, listen, when it comes to cash flows, what do? You will have to find out what is it, listen now, what is it that our subsidiary here paid as dividends to their shareholders? What is it that they pay, the subsidiary paid as dividend to their shareholders? Whatever the subsidiary paid as dividend to their shareholders this year, part of that dividend, listen, part of that dividend automatically was paid to the 20% shareholders in that company. Part of the dividends paid by the subsidiary, part of their dividend was paid to the 20% shareholders in their company. So we are saying, now as far as cash flows are concerned, between our group and the non-controlling interest, we must calculate what we are calling the cash dividends again, the cash dividends paid, now not received, we are the group paying, because we are one company, me and my subsidiary. And I've said, whatever the subsidiary paid as dividend to their shareholders, it is obvious what the group paid. So we are saying, if our subsidiary paid their shareholders whatever they paid, and part of that went to the non-controlling shareholders, who are the 20% guys, then how much is it, listen now, how much is it that as a group we paid to the non-controlling shareholders? How much is the dividend that we as a group we paid to the non-controlling shareholders as cash dividend? So the relationship, now I hope you are following, the relationship between the group and the non-controlling shareholders, I have said, is you determine the cash dividends paid, to the non-controlling shareholders. You determine the cash dividends paid to the non-controlling shareholders. Listen, once you get that cash dividends paid to the non-controlling shareholders, you take it now, listen, you take it now to the cash flow statement as part of financing activity, as part of financing activities. Listen, as part of financing activities. Why? Because these non-controlling shareholders, they are part of financiers. They are part of the financiers of the company. They are part of the financiers of the company. So in our cash flow statement, where we normally have dividends paid, now, listen, where we normally have dividends paid, we shall be having two categories of dividend when it comes to group cash flow. There is that dividend, listen, there is that dividend you as a group. Listen, there is that dividend you as a group you pay to your own shareholders, That is what we shall be calling dividends paid to group members. Dividends paid to group members. Dividends paid to group members, whatever you paid them, that's what you minus. Then there is another category of the dividends which we are now paying to the non-controlling shareholders. That's another dividend that we shall have to be deducting here, whatever it is. So for now, we are saying when it comes to group cash flow statement, there are two categories of dividend. The ones you as a group you pay to your own shareholders, and the ones you as a group you paid to the non-controlling shareholders, which is what we are talking about now. So we have said the relationship between the group and the non-controlling shareholders is you determine the cash dividends paid to the non-controlling shareholders. I have said, once you calculate it, that cash dividends paid to the non-controlling shareholders should be considered as a financing activity item. In the cash flow statement. I've also said, how do you get that cash dividends paid to the non-controlling shareholders? To determine the cash dividends paid to the non-controlling shareholders, again, we shall be opening an account called non-controlling interest. We determine or we prepare an account called non-controlling interest. So we shall be opening an account called non-controlling interest. Again, you feed in everything in this account. There will be a balancing figure, and that balancing figure automatically again will represent the cash dividend. Remember, we brought the 20% guys into the group because they are part of financials. So whatever is in the balance sheet as non-controlling interest, listen, whatever in the balance sheet as non-controlling interest, that implies it is what the outsiders financed, part of the group. Because we were consolidating everything of the subsidiary as though we control 100. 20% of what we brought in is not ours. It belongs to the non-controlling shareholders. So those guys must have financed part of the group. So whatever is in the balance sheet, listen, we owe to them that amount. So you bring down whatever balance you owe to them by the beginning of the year, which from this balance sheet I was trying to illustrate here, we were given an amount of 1 million last year as what they are entitled to, or what they financed the group by. That's what you bring down by the beginning of this year in your NCI, that 1 million, that amount of 1 million shillings. Then you go to the income statement again. You now go to the income statement, and in that income statement, there will be a share of profit for them. Which I was assuming to be how much? I was assuming to be 400, up there, 400. That profit of 400 share belonging to them, remember you have deducted it. It belongs to them. You have deducted it. By deducting it, it automatically means you have debited P&L account. But then it belongs to them. So you come and increase, you as a holding company, you come and increase what you owe to the non-controlling shareholders by their share of the profit this year. So you come and give them from the P&L account, what are they entitled to? From the P&L account, we have seen they are entitled to another 400. Then you carry down the balance by the end of the year, and you come and say from the balance sheet this year, what are they entitled to? In other words, we owe them how much by end of this year as part of what they financed the group by. from the balance sheet this year, I can see we owe them in the year 2020, we owe them 1.3 million. You owe them that 1.3 million. Once you enter that again, there will be a balancing figure. Once you enter that again, there will be a balancing figure in this account. And that balancing figure automatically will be the cash dividends paid, and that is what we are getting as a balancing figure to be. That is something like 100,000, and that 100,000 is what I said now becomes the cash flow item. In terms of that 100,000, take it to the cash flow statement among the financing activities, So in your cash flow statement, among the financing activity items, now, you will have cash dividends paid to the non-controlling shareholders, cash dividends paid to them. This will now amount to, 100,000. That will now amount to 100,000, and you are paying them. That is it. Okay, so I have talked about now, I have now talked about how to account, for the non-controlling interest in the cash flow statement for the group. I have said you determine what we call the cash dividends paid to the non-controlling shareholders. That cash dividends paid to the non-controlling shareholders, I've said, is considered as a financing activity item in where? In the cash flow statement. Is considered as a financing activity in DOEO. Then I've gone further and said, how do you determine that amount? We have said it is determined by preparing an account called non-controlling interest. You determine it as a balancing figure. That's what we've said. You determine it as a balancing figure in the account called non-controlling interest. Once you prepare that account called non-controlling interest and you feed everything in that account concerning them, then automatically the balancing figure in this account will become the cash dividends paid to the non-controlling shareholders. That is, you bring down the entitlement for them. Remember, this is what you owe to them. Bring it down as a liability by the beginning of the year. Then I've said, go to the income statement, pick their profit share. They are entitled to that profit share, which in our case we were assuming to be 400. They are entitled. So increase what you owe to them by crediting. That's what we have said. Then you carry down the balance by the end of the year as per the balance sheet by end of this year. Once you carry down the balance by end of this year, then the difference in this account will be the cash dividends paid to the non-controlling shareholders, So I have talked about how to account for associates. That's what I wanted to do today. How to account for associate in the cash flow, how to account for NCI, which is non-controlling interest, in the cash flow. Otherwise, I told you the other part of the cash flow is what you already know, how to predetermine the cash flow from operating, how to determine the cash flow from investing, how to determine the cash flow from financing. That is something you did in your previous accounting classes, So today we were just asking ourselves how to prepare or how to incorporate the concepts of the group. And one of the concepts of the group is associates. Number 2, non-controlling interest. And we have reminded ourselves now, in the actual sense, I have taught you how to account for non-controlling interest in the cash flow. Get the cash dividends paid. I've talked to you how to determine or how to account for associate in the cash flow. Get the cash dividend received. Okay? For the dividends paid to the non-controlling, it's part of financing. For the dividend received from the associate, it's an investing activity. So maybe for today we can stop there. We pick it up from there next time, when now we shall do a past paper question. So I want to stop there for now. We pick it up from there next time, where we shall now do a past paper question. So see you next time.